I am Noelle Atchison, author of the Crypto is Macro Now newsletter. And before you start to worry that you've come to the wrong place, I am stepping in for Scott today. I am, however, you'll be pleased to hear, joined by the usual gang, Mike, Dave, James. Hi, so good to see you. How are you guys?
Hello.
All good.
And before we dive into this, do please hit subscribe if you're watching this on YouTube. The button is just down there. And if you've already done that and you like the show, do please hit the like button, which is right next to it. It'll help more people find the show. And thank you in advance. So let's dive right in. Mike, I want to hear from you first, please. What is the macro mood in Bloomberg today?
It was kind of subdued this morning. Chris Collins, a U.S. economist, pointed out he doesn't expect much from Chairman Powell at Jackson Hole on Friday, because last year he used Jackson Hole to tilt towards easing, which started in September. But things have changed since then. It's switching over to Ira Jersey and U.S. rates. Expects the market's basically priced for rates to drop to 3 to 3.75%, the lower bound of cuts. He expects much steeper cuts to happen as things get going. And he said the long end could sell off a bit because of higher inflation, fiscal stimulus, rising deficit. Audrey Schild-Freeman's pointed out dollar weakness is kind of still her bias, particularly as expects the Fed to start cutting rates later on as ECB and other central banks will start curtailing their cuts because they're running ahead. So it still expects the dollar to be weaker in the next 12 months. Michael Casper was our equities strategist, fitting in for Gina Martin Adams, who, by the way, has left the firm. If you're looking for some really good talent, she's on the market. He says, point out PPIs obviously running hotter than CPIs typically is a bad sign for operating margin contraction, just pointed out, but earnings have been hot and strong and been beating a lot of estimates, but he pointed out that some of the key things are just pointing out to overheated pairwise correlations. Michael's very much of a quant, are quite extreme. Small cap earnings have been good, but watching manufacturing PMIs for small caps earnings this week. And then I focus on commodities. I just want to point out how historic this year. I point out how historic this year is by just looking at gold versus crude oil. Right now, it takes 53 barrels of crude oil per 1 ounce of gold. As we head towards year end, looking back at year ends, going back 100 years, there's only been 2, any close to that. And the highest closes ever were in 1933 at 39. And 2020 at 39. So we're running historic levels here now, gold versus everything. And I just don't see what really stops gold from going higher. It's got a nice little bull flag pattern. To me, it's just waiting. Central ETF buyers have shifted to major inflows. Central banks are still buying. And I still see pressure on crude oil. Some kind of a shock's going to take it to not get cheap like it always has. 3 times since 2020, get towards $40 a barrel. So and I also point out it's not alone. Natural gas is doing the same, corn's doing the same, grain's doing the same. And then I ended up with, to me, the key commodity that has to go up and is risk of putting in a peak like crude oil did in 2008 is copper. Copper has this very similar situation. It's now inching lower, it's still up in the year, but if it heads any lower from here, it'll put in a peak that might be as enduring as crude oil since 2008. We've never got above that level. And then, of course, I'm watching that Bitcoin gold ratio. I pointed out, I still, the range for the year has really been from 25 to 36 recently, peaking back downward. And I think it's much more likely that gold's going to outperform Bitcoin if the stock market backs up a little bit. And it is August. It's August 18th, peak summer doldrums. Back to you, Noel.
We wish they were summer doldrums. Mike, I have a follow-up on oil. What's your sense of how much geopolitics is playing into that weakness now? We are arguably, hopefully, closer to the end of the war in Europe that we have been since February 22. Hopefully, she says, as a European resident on the panel. But I don't see any indication from that in the oil market.
So I wrote about it in 2022. I enjoyed pointing out the best way to really hurt the Russian war machine is crush the price of oil. And where did Trump go when he first got elected? Straight to Saudi Arabia. So the market should be figuring out what's going on. They're trying to do everything they can to get the price of oil lower. Now, sir, and we had that little spike on hostilities in the Middle East. It got it to near 80, and here we are pushing at 62 below last year's low. And I don't see what's going to make it go higher. So geopolitics are completely coordinated on a global basis for lower prices, I think. I don't see what stops it. You need some kind of shock And the key thing is if there is some more détente in Europe, one of the first markets to get hit will be natural gas in Europe. But U.S. natural gas has already started pricing for that. The U.S. front natural gas price is back down to 287. That's down 20% in the year. The price way out in January was up at $5 just a few months ago. Now it's pushing towards $4. And the whole world was, had a pretty colder than normal winter last year. We need another one of those. Those prices will go down. So we need some kind of surprise. Geopolitics, I think, are completely coordinated towards lower oil prices, at least for now. And some kind of shock in that system will take it to go higher. I don't see what it is. And that's what we head towards the end of the year. We've already passed peak driving season or near it. And so the problem is everybody's bearish, which, tweaks my, as Scott said, spidey senses of contrarianism.
James, do you agree that the dollar's heading lower?
I mean, look, if rates are heading lower, so it's just a question of timing. And so, of course, the dollar is going to be pretty tied to that. And oil is in the mix too. But I mean, all eyes are clearly on the Fed. Almost 50% of the articles that are on my Bloomberg feed right now are something about the Fed or about Jackson Hole or about what Powell has done or what Powell might do. And I wrote about this last weekend in my newsletter. For those who already read it, they know that I think that it's a very high probability that that Powell uses the data from the last few weeks to kind of have air cover to ease a little bit, but not, they're not going to do I don't think they're going to do a 50 basis point cut right out of the gates. I think that would be, I also don't think that it's necessary. I think that might send the wrong signal to the markets that they're it might be jarring, even though the market's priced in a full cut and then some last week. The Fed funds futures, it showed over 100% chance of a 25 basis point cut, which means that some investors are betting that or hedging against a 50 basis point cut out of the gates like they did last year, like Mike was saying. But we're in a completely different position. This is not a political move right before an election. This is a situation where you've got Powell who wants to cement his legacy that's closer to Volcker than Burns. And so what he wants to do is kind of have his victory lap. Like one of the Bloomberg articles I read this morning was, it's kind of like his valedictorian speech, like he's gonna say, okay, I did it, and often Fed chairs will use this last meeting and this situation to kind of write their history, their own biography, to say what we did, how we're doing. So we'll see. It's just a different kind of, for those people who are wondering what the heck we're talking about. The Fed meets at Jackson Hole this week, and it's actually a lot more than that. It's called the Economic Symposium.
Everyone's there, right? From the central bank.
Now it's central bankers from around the world, economists, leaders. It's become a circus, a zoo. It used to be a really tight, small meeting, and for them to kind of batter on ideas and maybe float some ideas of policy, but now it's gotten to be just a circus. And so the world descends on this little town in Wyoming, this small city, and everybody is standing waiting to hear comments from the Fed chair on Friday morning. How'd it go? How was the barbecue? But really, did you catch any fish? But and investors used to think, it used to be where, it was kind of off the cuff, a little bit more relaxed. It wasn't it wasn't a formal setting where you've got a podium and a bunch of reporters that are lined up for their questions. It used to be just kind of off the cuff. Well, this is how we feel. And so you might have gotten a little bit more, a little bit less guarded answers in the past, but now I think it's pretty well scripted. I think it's they use this as this is us off the cuff, but it's not off the cuff. Everything that he says Every single word and syllable he utters, he knows that people are hanging on, and markets will react to it. And so what I think is, there are a lot of different dangers to what he could say, and we can talk about that, but I believe that he's going to come out and be very, he's still going to be very guarded with his words and very vague, and he'll open the door to a 25 basis point cut, but he'll pretty much shut the door on a 50 basis point cut and say, look, we're still data dependent. We think that inflation's moving in the right direction. We think that, the jobs are clearly we have to pay attention to those job numbers. And that's the second mandate, right? So stable pricing, full unemployment, whatever that means. And so, but I think he's going to say something along the lines of, we're still watching the tariffs to see if this is just like a one-time pass through, or if this is going to be structurally higher prices for a while. So we can all have our beliefs on what that really will be. It's a pretty complicated situation, but I think that's where he comes out, and I think that's what the markets are kind of pricing in here. So to Mike's point, yeah, the 2-year Treasury, which is kind of the benchmark for inflation expectations, and actually the 10 years really the benchmark for that. The 2 years, the expectation for the Fed policy, right? So where are Fed funds going to be over the next couple of years? And this kind of averages out that, because it's on a duration curve. So it averages out what people's expectations are. It doesn't mean that people think that rates are going to 375 in 2 years. It means it's going to go lower than that, because it's got to average out your duration over that time, right? So that's what you're looking at. And when you had those unemployment numbers, and then the CPI coupled with it, you had this 2-year really drop hard, and yield drop hard from just about 4% down to 370, 365. And so, but that's come up a little bit, and people are tempering their expectations of the cuts. It's a long answer, but that's kind of where my head's at.
We also on Friday will get a review of the Fed policy targets when they share their new framework going forward. That could also add some confusion, as if we didn't already had enough. Dave, you've been nodding and shaking your head through James' answer there. Dive in.
Part of me is just disgusted with the notion that, these group of policy wonks who have basically been wrong for 40 years in their economic projections, 20,000 employees, 900 PhD economists, and frankly, a monkey throwing darts does a better job of predicting what's going to happen in the economy, that we hang on their every word. That said, we do hang on their every word, and markets do react to everything they say, and they will care if he had a bad cup of coffee on Friday morning versus a good one where he's happy. And that's just kind of the world we live in, and it's sad. It's all theater. The reality is they are going to print money in order to fund fiscal deficits, that it is them and all the other central bankers. In my mind, the most important story of the last week is the one that we haven't talked about. And it's actually a very interesting one. It's Larry Fink becoming the head of the World Economic Forum. Now, we laugh, but ask yourself a question. What is the final boss for Bitcoin to actually make Mike say, oops, vis-a-vis gold? And the answer is when central banks consider it an asset. Right now, central banks do not consider Bitcoin a viable asset. They consider it a speculative piece of something. I don't know, they have different words for it, but no central bank has adopted it whatsoever. And they are 100% believe the gold is a strategic asset, and that's why central banks have been buying it. Ask yourself the question, having someone who is on record as saying Bitcoin at 500,000 is a completely normal and 700,000 wouldn't be crazy based on the price of gold as it was when he made those things, being head of the World Economic Forum is relevant. And the answer to that is, if you're not paying attention, the answer is, of course, yes. And it does matter. And the theater that we're all subjected to from the Fed And from all the talking heads that we see, really, it's a question of where does it emanate from? Now, I'm not going to get like some of the conspiracy theorists on X. There are lots of them who think that these guys are plotting to make us all eat bugs or whatever. I mean, I'm not going to go down that rabbit hole. That's nonsense. But they do want to control the economy, and by having somebody who believes that Bitcoin can be a part of that reserve asset conversation as one of the key power, he already was one of the key power brokers, but now officially so, it's very, very relevant. So yeah, we'll have our central bank theater on Friday. And yes, in September, they'll wave his arms, he'll take his victory lap, whatever. I mean, look, there's three ways that Powell could go. He could identify himself as an anti-Trumper with severe Trump derangement syndrome and say, F you, you're wrong, and effectively fight, in which case you'll have a split vote for sure. We had a split vote last time. It'll be even worse because there are a bunch of other Fed governors that probably want to stay on as Fed governors who won't if they go along with it. Or he could go the opposite way and say, you know what, wave the white flag and do, a 50 basis point cut. But I agree with James. I think that is exceedingly unlikely, regardless of the fact that some people do have that as possible in the dot plot. So we're left with what is going to happen is almost certainly what James said, which is to say, no surprise, things move in that direction and the markets are left to their own devices. So that's my thought on the Fed. I think there are, and what's going on that part of the macro picture. The other part of the macro picture that people refuse to talk about is the dichotomy between the consumer prices and producer prices. A large part of that is expectations of rent. You may have noticed that mortgage prices have been steadily creeping downwards. And that, because 40% of CPI is owner's equivalent rent, that is why CPI and PPI are diverging slightly. That is one of the reasons. There are some other reasons in there, some of which are transitory. It's not worth going into, but I think all of that matters. Now, why does that particular fact matter? That particular fact matters because if you are trying to control inflation and if you actually care about such things as opposed to the theater, then what are you going to try to do? Well, one of the things you want to have happen is long rates to come down. And so you're literally targeting the long end in order to decrease consumer inflation because of owner's equivalent rent. And the long end is kind of tricky because mortgages are based on a blend. There's ARMs, there's a lot of different pieces. We always reflexively say it's the 10-year. It's not really true. But
they're keyed off. They're keyed off of it. They're keyed off.
Totally right. 100%. Anyway, that's that. I think that's what people need to watch. Watching the longer end, maybe somewhere in the 2 to 10 matters. The 7 and how it gets there matters. That's going to matter for a lot of financial assets. Lastly, I want to tee up Mike, and that is a lot of people have asked a lot of questions of. What is all this saying as we enter the fall? And the answer is, I think this fall is a high risk season from a market's point of view. Full stop. Not saying it's going to crash. I'm saying there is, if there was a crash-o-meter that says probability of crash, that it is a double-digit integer. Probably a low double-digit integer, but still a double-digit integer. Why? Valuations are extremely stretched. The Fed is likely to be, to kind of start doing what the administration wants, which means people will have the perception of less artillery in the chamber, as it were, behind it. And the fall, when asset managers want to sell, the question is, or to lock in their gains, the question is, will there be liquidity there? And I think, and I'm talking about the stock market now. I haven't mentioned crypto yet because there's some other things in crypto we should get to, but I don't want to monologue, through that. But I do think that, and it really is interesting to understand whether or not we are entering a risky period in stock assets and extended assets that are directly tied to earnings in the economy, which, by the way, look good right now. And all the analysts are saying earnings look good. If by good we mean continuing to increase at close to a 10% clip. So I'm curious, what do your people around? What do the Bloomberg folks think about projecting into October of this year, Mike?
Yeah, well, that's the million-dollar question, and Dave, I think you nailed it. And we all know, veteran traders, that we all know the volatility is going to pick up, and we'll get that dip. Everyone's going to buy it, and it's going to go straight back up. But I do appreciate you mentioning things like Larry Fink. I don't know how you did in 1998 when long-term capital collapsed. I did very well with clients, just noticing patterns in out-of-the-money Eurodollar options that were. Fed was tightening, and these out of the money prices kept going higher. I'm like, all right, something's wrong here. We just bought some, they expired, and the ones that finally worked went up 10, 20x. It just took a while. I see similar situations now. Yeah, it's a volatile time of season, time of year. We all know you don't want to be buying volatility or buying the market and selling volatility in August. You want to wait till it spikes, and it's going to spike. We're getting a little bit of that now. It's just minor stuff. The key thing I like to point out is the macro. First, look back from the future of the macro. We have a most discombobulating, unconformist president in somewhat maybe history measures. Now you can, and it's not making a point about him, but it's a point about markets. To look at back this period from the history and say, oh, that was awesome. Within the first few months of him becoming president, we corrected less than 20% of stock market, it recovered, and then everything was fine. And all the cryptocurrencies that helped get him elected were fine, went straight up. Well, I'm going to look back at that kind of scenario from the future. I think is very unlikely. We're going to look back, I think, from the future and expect and have read about a lot more volatility as we shake up the world order. So what's happened so far this year, let's just tilt over the Bitcoin. It's proving it's a risk-on asset. The absolute high for the year in Bitcoin came last week when the VIX traded at the low for the year, 14.5. To put that in context, the last 2 years, the VIX averaged around 14 or 15%. This year, the average is 20%. I suspect by the end of the year, it's going to head that way. Yes, I have a bias. Volatility is going up, stock market's going down. I've been wrong on that. The year so far, the Bitcoin's low came on April 8th. That was the day that the VIX peaked at 52. That was the closing basis. So you see the difference now, and that's why I'm sticking with gold. Gold's becoming more and more of a risk asset. Central banks get it. Investors are now getting it. And what you're seeing in crypto, I think, is massive speculative excesses compared to similar what I saw with the hubris of long-term capital management, with the peak of the internet bubble in 1999, with the peak of the Japanese stock market in 1989. And now we're going to start a little bit of a flush. So the question is how far, how fast, and what are my indications? So I look at commodities. Clear deflationary forces in crude oil, happening in natural gas, happening in all the grains. You're not seeing those demand forces. That's a typical cycle to a lower price after a higher price. I think we're getting that in cryptos and Bitcoins. Bitcoin might be different, but I'm sorry, there was one cryptocurrency in 2009. Now there's 19 million, so there's massive supply. I think they're going to get towards a low price cure. Right now, it's just a little bit too high, and I think they're the best leading indicator on the planet. So to me, that's the things to watch into the year end. Let's put it this way. So how are we going to end this year? Is going to be a major setup. We're going to get some volatility. Maybe it's starting now. It's only August. Let's see what we feel about this in September, October. Does it bottom and go back up? It basically, the way I look at the stock market, has to go back up. Or things like copper are starting to tilt lower. There's really no hope for crude oil. There's really no hope for even some of the grains, unless the stock market, in the industrial metals, unless the stock market stays lofty. And I think then the whole world facing these tariffs is going to start kicking in matter. And the one key thing that will start be hurting eventually is U.S. earnings, as U.S. companies pay those tariffs.
Not to mention skepticism about the vast amount of capex for the AI productivity boom that we are no doubt getting. James, I want you to run with that. But first, could you open with a view a year from now? You're looking back on this year, and what was the biggest change?
The biggest change? Well, look, I think a year from now, liquidity starts to dry up. So where are we? We're in August 2025, August 2026. I do think we've already cycle peak. I think Mike is right. I just think he's a little bit early here. Look for volatility to drop off the map any minute, or volatility to pick up, and for the stock market to drop off and have a serious correction. I just think that it's going to take a while. We still have expansion of liquidity happening from central banks, and we're going to continue to see kind of what Dave was alluding to, some sort of yield curve control at the long end of the curve. And what that means is, we've got like we're still running $2 trillion deficits. Doge tried, but I mean, it's like taking a couple of deck chairs off the Titanic. I mean, like it's still pretty heavy. It's gonna, it's still weighted. So the issue is here that we're running those deficits. We're continuing to expand liquidity to match that, and you have to. It's a first principle. Even if we do get a drawdown, they're going to come back with some sort of fire hose. I don't know if it's a money bazooka. It really depends on the kind of downturn we have. But if you pull back and go really, really big picture, yeah, Mike, he's Trump. Like I'm not rah rah. I love Trump and everything he does. He's made plenty of mistakes, and he is unorthodox, and that's what has people on edge. You've got a cadre of European leaders flying to plead with him to be to be on Ukraine's side here, whereas all he wants to do is stop the war. Well, at least that's how he's positioning. So, but the point is, unorthodox or not, what does Trump care about? He cares about his legacy. And what is really his biggest benchmark to his legacy? The stock market. He talks about it all the time. He talks about rates because he wants rates down, because he wants GDP nominally to go up to expand liquidity so the stock market will go up. And we have 1 year until midterms now. And so we're already halfway there. He can't have a full-on collapse between now and midterms, so that collapses his legacy, So I do believe this is going to be extended for a while. I think it's going to be really hard. This is probably the most difficult part of this cycle, is trying to time just how long this could play out. And I think it's going to catch people off guard, and we're going to continue to expand into next year. And so, yes, Bitcoin has been and continues to be treated as a risk asset on Wall Street. No, it is not one of the thousands of cryptocurrencies. It's clearly separated from that, and it's been separated from that because it is talked about separately from every other cryptocurrency. So they all key off of Bitcoin. The only one that is kind of beginning to march in a different direction a little bit is ETH, and that's because I think that with stablecoin bill, that changes the use case for ETH and strengthens it. Although it's not the only one that could be used for stable coins, clearly, but there is a use case for it, and that's kind of solidifying. But Bitcoin is different, and we're not going to get into that argument again and debate again here today, because I think our listeners are tired of hearing it. But let's go back to the point. The point is that it is still being used as a risk asset. You could see it. It moves in weekends where there's uncertainty, just like this weekend, and on such little volume. I mean, like, this is super unimpressive. The volume was anemic this weekend, so it's not that big of a deal, in my opinion. It was more of a buyer strike than a deluge of sellers. Okay, so
a short term movement, but you've been stressing that this is a longer term play. Anyways, that isn't just susceptible to U.S. liquidity outlook; it's a global liquidity play.
Exactly. All central banks are, but they're all keying off each other. So they're all in deficit, the developed countries, and they need to continue to expand liquidity to match it. So.
And the lower dollar helps.
Yeah, and will Bitcoin be suffer in that environment? Of course it will. I mean, it's still that's how it's been positioned. Unless we have something that's more catastrophic, that I don't wish for. If we have something that's more catastrophic, which is meltdown in the banking system, I think Bitcoin acts a little bit differently than you would expect, and it would act much more like gold. So. But that's not what I'm hoping for, and that's not what I expect. So whatever the black swan is, buckle in.
Dave, could you talk about what you see being the main Bitcoin drivers now as opposed to ETH drivers, or do you think they're starting to run in tandem?
Well, they're definitely not running in tandem. The Bitcoin driver is adoption. That's the only thing that matters. Other than that, we're in a trading range. we've been in it. I'm a broken record about this, but when you look at you zoom out even a tiny bit, we broke through. We had a trading range where we had a dip down into the 70s. It was the 70s through to 112 was a very serious resistance level that people talk about, and it sat in that range for many, many months. It broke through that range and to become into a smaller range, which, by the way, is a classic bull market setup of between, where are we, 112 as support down to up to 122 with some flipping around. And, we're settling down. We're in the middle of that range, settling down on low volatility as it waits. If you look at Bitcoin volatility, and it is at lows we haven't seen since the summer of 23. Do you remember where we were at the summer of 23? We were in the 20s. And in the summer of 23, we had some rather substantive interest. Its volatility was really low. That was when we had the fake flush from 29 to 26 that got everybody panicked. Because in percentage terms, it was a big deal. It was a liquidity cascade, etc. We're not seeing any of that right now, but it is relevant because, and by the way, I can coordinate. I was just checking volumes. Yeah, the weekend volumes were the lowest we've seen in a long time. So it's classic summer doldrums. That's fine, but the reality of Bitcoin is it's range bound with low volume, nowhere near enough sellers. And look, I'm preparing some reports on TCA during July, and transaction cost analysis from CoinRoute's clients in July, and the amount of institutional orders that were absorbed by the market, both buying and selling, was extreme, with costs that would effectively be cheaper than any top 10 market cap stock. And so there's a lot of liquidity in the market that's there at a certain price. But right now, we're not near there. Now, ETH is something total. And oh, by the way, there's two other things in Bitcoin. One is the MicroStrategy effect. When volatility, people do not understand this. And there are a lot of people who are about to get caught off sides. I see James smiling. Maybe you know where I'm going with this. MicroStrategy is a major seller of vol in order to buy Bitcoin. MicroStrategy stock has been languishing. All of their stuff has been languishing as Bitcoin volatility plumbs toward the lows. As Mike is fond of saying, don't sell the extreme low, don't buy the extreme high. Volatility in Bitcoin terms is approaching the extreme low. That is what is depressing the prices of the MicroStrategy complex and a lot of people that are in there. There are a lot of shorts that are piling up, because it's become a very de rigueur trade to short MicroStrategy, which effectively means if Bitcoin volatility picks up, just volatility picks up, that the whole thing is going to create a gamma squeeze. It is definitely building towards that. It's not there yet, but we could enter September with a very, very interesting short leverage play on Bitcoin in a place that people aren't looking. Everyone thinks of the digital asset treasuries, so-called DATs, as the reason for the next crash. I actually think it's the opposite. I think the DATs are the reason for the next rally, because when people are forced to scramble to cover their shorts, and we've seen this time and time again in markets when things get irrational. Now, Ether is something totally different. Ether, if you look at it, had really, really bad news. It was dramatically lower. It was a hated asset. And into that world, Tom Lee jumps in with a really good track record and a bazooka full of money. And so what happened? It was an epic short covering rally, an epic, lack of sellers. People stopped selling. And the path from 2000, actually 1400, but 2000 was more of a stable price, to 5,000, which is a huge rally in percentage terms. I mean, put that in perspective. If Bitcoin rallied the same amount, we'd be at like 250 right now. So it's a very big difference. But the reason behind it is the stablecoin bill. Yet there was news that the markets ignored in Ether, although it seems like it's no longer ignoring it. That the largest stablecoin issuer that for under the Genius Act, Circle, is not going to use Ether. They're going to use their own blockchain, right? And the news that Stripe is going to build their own blockchain. And effectively, you could get wrapped around the axle about whose blockchain people are going to use, but understand something. This is important. When Wall Street or banks or anybody else wants to use a financial technology to underpin their product set, the most important things they care about are it works and it's cheap. They want it to work because obviously they want it to work, but they don't want to pay a lot of money to the underlying plumbing if they don't have to. So then you ask yourself the question, well, do they have to? And if they have to, like in the case of a Swift, they have no choice because it's the only thing. In the case of stablecoins, though, what blockchain they want to use. I mean, Tether, it does most of its volume on Tron. Tron's market cap is just a little bit below Ether. I mean, right now, where's Tron? I have to go down a while to find it. Tron's market cap is $33 billion. Ether is over $500 billion, right? So you start asking yourself the drivers, doesn't make sense? Well, the answer is sort of. It's not stable coins that are going to drive Ether. It's the ability to tokenize assets and have them transact easily. And so you have to ask yourself, is that a long-term or a short-term? And what does that mean? And who's going to win? And there's all sorts of uncertainty there. The potential is still huge. There's no doubt. But the risk is much higher. And when the market starts pricing the risk of Ether the same as the risk of Bitcoin, it's fundamentally wrong. And so I just want to conclude by saying that the 19 million, forget the 19 million, because most of that is pump.fund. But when you start talking about 1,000 serious crypto, assets that people look at, and probably, a few hundred, there's one. And then if we're looking at a few hundred, and 299, if you're looking at 300, Ether leads the list of the 299. Bitcoin is the one. And that doesn't mean I'm a Bitcoin maxi and I don't think there's value in the others. It does, however, mean you have to look at them differently. Just like you look at Nvidia different than JP Morgan. They're very different. And you can see days where Nvidia goes up and JP Morgan goes down. Sure, there are days when they both go up and down at the same time, but there are quite a few days when they go the opposite.
I want to wrap that into what you were saying earlier, Dave, about Larry Fink assuming temporary directorship of the World Economic Forum, and whether this is, where the biggest impact is going to be. I want to throw it first to James, and then Mike, I want to get your take on that. James, do you think the World Economic Forum is relevant enough for this to have an impact on how global markets develop?
Sure. I mean, Klaus Schwab has created a situation where he's in every single major leader's office continuously in their ear telling him what to do. So remember, though, the BlackRock's Fink being the head is temporary. So we don't know who's going to be in there long term. And do we know how long he's going to be there, Dave?
No, but I've seen all sorts of rumors and innuendo. The problem is the innuendo mill when it comes to BlackRock. There's so many conspiracy theorists. There's so much, which is ridiculous. I mean,
the WEF as well.
The dumbest thing here. Well, the dumbest thing. It's hard because it's confusing to people. It's BlackRock bought this much Bitcoin. Blah blah. No, they bought the ETF. Bought the Bitcoin, and the ETF was bought by the investors, the underlying investors. So, and you have a custodian. They're the creator of the ETF, and they're the manager of the ETF. But the owners, it's just like the argument that institutions are only acting for themselves. Well, no, the institutions are acting for their underlying beneficiaries. So if you have a foundation, it could be a small number of beneficiaries if it's a foundation for some sort of art museum or something like that. But if it's an endowment for a university, there's a lot of beneficiaries there. And then if it's a pension fund, a retirement fund, well, there's thousands or tens of thousands or sometimes hundreds of thousands of beneficiaries. It could be millions for some of these companies that have been around forever. But there are thousands or tens of thousands of beneficiaries to those pension funds. So that's one of the things that you have to look at, that when people get upset about institutions being in the market and doing things, it's what goes back to what Dave was saying, which is the most important development, long-term maturity for Bitcoin is understanding. As more institutions get into this, there's more understanding, which goes full circle back to your question, Noel, which is For Bitcoin in particular, I think it's very important because it brings it straight onto the biggest stage in the financial leader world, meaning of the leaders of all these central banks and all of these governments. They have no choice but to listen now to why Larry Fink thinks that this is an important asset, why it is separate from everything else, and why it is digital gold. And so they have to hear it. You know, it's kind of like when Microsoft gets, they have a one shareholder that says, you need to hear Michael Saylor tell you why you should have Bitcoin on your treasury. And they say, fine, he literally has 2 minutes, you know, we'll give him 2 minutes on the board and that, you know, to go through his presentation. And it's just, we'll hear it, but we're not going to hear it. Well, now if you have BlackRock on this, in this position, which unfortunately does wield a lot of influence and power, then these leaders are going to have no choice but to hear it. And it's going to be all over the place. Again, central to many conversations about global economy. And so that is a very important thing, because it's not that it just gets shoved down people's throats. It's that they have no choice, but that's what's on stage. That's what they have to hear about. And if that's what, you know, all of the mainstream media decides to focus on for a while, then you have no choice but to hear it. And that's kind of what the same situation here, in my opinion.
And he's also known for insisting that everything will be tokenized sooner rather than later. Mike, I know you touched on this earlier, but Dave's quite right. This is an overlooked development. So could you expand a bit more about why you think Fink is going to be relevant in his WEF role?
Well, what's first what you said about tokenization? That's exactly right. It's, I mean, someone who came from futures and being in the trading pits in Chicago, and all the New York traders used to get pissed off when the futures market in Chicago moved the treasury market. That's happening, and it's just a better technology. Tokenization is overwhelming. It's a key trend I'll continue to point out in this space. It's the proliferation of crypto dollars now, or stable coins. Now, yes, most of that's used to trade cryptos, but all that's going to treasuries. It's a good thing. Finally, our Trump administration figured it out. But just remember what Larry Fink is. He's in a great space. The thing we used to say when we were in the pits, we're selling shovels. He was great. He's you know, he's making money because people are buying his products to track ETFs. So let's dig into some of the things that's been said here and what's happening now. Everything that Dave said about how market's so bullish and thing is exactly very similar, mirrors what I remember hearing in 1999 with internet sex, in 2007 and 2006 with the housing market. Heard it before, sounds like exactly the same. It's the hubris and it's the human nature of bubbles getting towards extremes. So Dave also mentioned low volatility in Bitcoin. It's actually not very low. It's volatility in everything. So if you look Bitcoin 60-day volatility, it's at 26.6%. It's somewhat low, but divide by the S&P 500 at 10%, that's 2.6 times the S&P 500. The average over the last 5 years is 3. It's right there. See what matters? The stock market is all that matters. Then we point out over earlier about something about, you know, Trump and really into how wonderful the stock market's doing. But just remember where he came in the president. In history, there's only one president in that country had a similar level of stock market capitalization. It was Herbert Hoover. Didn't work out so well. So that's my point, is these things are all trickling down to things we've all seen before, and prudent investors don't just buy highs and try to put treasury and Bitcoin in the same sentence, which is an oxymoron. Treasury means treasuries, not Bitcoin, a highly speculative digital asset. And then, I'm sorry, I come from an index environment, S&P. When we create an index, we use an index of things that are similar. Well, there's things called cryptocurrencies, and there's thousands of them. Bitcoin's just one of them. You take out the stable coins because they don't pay interest, and that's the key thing to remember about tokenization. Tokenization is going to bring on-chain stuff that plays interest, tracks actual markets, actual markets that have earnings. Then we have thousands of cryptocurrencies that are just numbers on the screen. They track nothing. They have to hope they're wonderful. And I just point out the key thing to remember about Michael Saylor. I completely agreed with him in 2010 when he noticed his MicroStrategy company at that time, which was a software company, was not going to make it, and tilted over the Bitcoin and did a great trade. It was awesome. He got a 10x. And now he's doubling down at the highest levels and markets at very expensive levels in August. Not a good idea. I like to say we're going to at least get a little bit of a flush, maybe 20% correction in Bitcoin. Remember, 50% corrections are normal. But now we're at the stage where this whole asset class, particularly Bitcoin, has systematic risk. I didn't say systemic, systematic risk, which I have never seen. If it does what's normal, drops 50%, it takes the whole system with it. It's severe deflation following deflation. And we've seen signs of that, certainly in China. Right now, they have minus 3.6 PPI. Their money supply is running double the US, about 45 trillion, and their debt to GDP by some estimates is 300%. In Japan, it's 200%. The world's tilting that way. The whole world is dependent on US stock market saying lofty, and we have the highest correlation ever between cryptos in the stock market, and we have hubris and signs of 1999 excesses at the peak. I say stick with gold. And what's been right so far? Gold. I think gold's going to continue to outperform.
Speaking
So,
of,
sorry,
okay, Dave,
I just
jump
have
in,
to
but
point
fast.
out. I just have to point something out. Look, I was trading in 1999 and 98 and 2000, and Bitcoin. In fact, Ether kind of had a shadow run that sort of looked like that. Maybe if you kind of squint at it through one eye, but we haven't seen anything close to euphoria. We've seen no margin buying in the crypto complex. I mean, funding rates have been below below standard, below average now for so many months on end. You know, even in the liquidations over the last week, we saw something we've never seen before. We've seen, in fact, even the last 24 hours, we see Ether with double the amount of liquidation of Bitcoin. Bitcoin liquidations are at crazy low levels because there's no leverage in Bitcoin. Very, very, very low. So every time you talk about hubris and euphoria, it's just missing the fact that there is no there there. It's just not true. Now, there will be times when it will happen. We've seen it before. I've alluded to several in this conversation, but that's just not there. So other stuff you talked about, fine. You know, we'll let Noel drive the conversation. But no, I'm sticking. You're entitled to your own opinions, not your own facts. There is no froth in any measure, in any metric in Bitcoin other than maybe price. And that's a matter of opinion, but there's certainly no leverage in the system. The liquidations are small. The fundings, open interest, everything is low. And volatility, predicted volatility in the Bitcoin market is at a Bitcoin-oriented low. Sorry.
Okay, relevant to that, I want to do a sidestep and pull on something that blew me away last week and does tie into everything that we've been talking about, and that is the latest Bank of America Fund Manager Survey, which has, for the first time this cycle, long crypto in the most crowded trade section. Remember, last cycle, long crypto was a regular top of list vote from fund managers, and these are global fund managers surveyed as the most crowded trade. Now it's back for the first time this cycle, which suggests that maybe there's a teensy bit of froth coming in, but really not much, because only 9% of respondents voted that as the most crowded trade, whereas 12% said long gold was much more crowded. Now, what is interesting there is that most of the respondents don't even hold crypto to start with, which is another tailwind that I think is largely overlooked. And who wants to run with that? Who's actually paid attention to this?
When the tide goes out, we'll see who's wearing clothes. Simple as that. Warren Buffett's way overweight cash for a reason. He obviously doesn't like the rock. I like the rock. I hate the fact the rock's outperforming everything. But if you look back, just the S&P 500 versus S&P 500 total return, stocks, rock's been beating the S&P 500 for almost 7-8 years, the same level. I mean, that's not good. As Dave knows, he doesn't like when I point it out, but you have to go back to 2021 for the same level in Bitcoin versus gold. These are bad signs with markets in August at all-time highs and a new president that's completely dependent on the stock market and Bitcoin going up. And we're early on. So I just, it's, to me, that's...
I mean, Noel, the thing that's interesting here is gold beating the stock market is another way of expressing the stock market denominated in dollars. And there are more dollars, and gold captures the effect of more dollars. Full stop. That's what you're talking about. I can't repeat it for the 1,000th time on this show. What I can say is that Bitcoin in that conversation, it's all about adoption. In 2021, the Bitcoin network was 1/6 as strong as it is today. 1/6. And so, yeah, I mean, am I saying Bitcoin's going to 6x from here relative to what it is? I mean, I suppose Larry Fink has that. That's the middle of his range, by the way. So it's not like it's a crazy number. Is it going to happen immediately? Of course not. Well, I shouldn't say of course not. Unlikely is probably the best answer. it's you just have to look at it now. Now, when you talk about crypto, though, Ether had huge inflows, right? In over the last week. I'm not sold on Ether. I wouldn't say I'm bearish on it particularly in the long run. I don't know. I just think that on a risk-adjusted basis, Ether's price seems very expensive to me on a risk-adjusted basis compared to Bitcoin. That's the way I would phrase it. I think that a large amount of it has to do with, will Tom Lee and others, continue? Will those inflows that came in last week be sticky or not? And that's going to be a fascinating topic. I don't know the answer to it. I just don't see it in the same breath. And that makes me, I had a very convivial conversation with Max Kaiser on a Spaces last week, where he and I were in agreement. Now, in the past, there are a couple things he says that drive me nuts. But the truth is that if you look at the value proposition for Ethereum versus Bitcoin, they're very different. Now, he, of course, says all sorts of really nasty stuff about every altcoin, whatever. But, it is, we are getting to a point where there's different investor cases for different cryptos, just like there's different investor cases for different stocks. And you have to, and we could go through all of them, but this is a macro show, so that's not really the point. The point is that on the macro level, saying they're all the same, probably not a good idea.
Speaking of altcoins, I've been asked a couple of times over the past week, does the ETH run signal the beginning of altcoin season? And I'm going to go out on a limb and I say most of us here would say no. But James, can you expand on that? What would you look for a sign that altcoin season is starting?
Well, I mean, look, I'm not an expert by any means on altcoins. I've only traded a handful of them. That was in the beginning of me even entering this whole space and trying to understand it. So I don't trade any of them ever. That's just me. But what I do know is that Bitcoin is the bait. That is the ballast for all of them. So if you're looking for a clue of where everything goes, look to Bitcoin. And if Bitcoin rips higher, well, then of course altcoins are going to follow, and they're going to outpace Bitcoin, some of them, because they have a higher beta to Bitcoin. It's not the reverse, and that's now I do believe that we could have a downturn here in the next couple of months. It's just, we're in the summer doldrums. Like, we're literally all on vacation here, I mean, I'm on vacation, but like the market is so quiet. This drawdown this weekend from Bitcoin was, again, it was on anemic volumes. It's a buyer strike, not a herd of sellers. It's a big difference. And so people are just kind of stepping back to see what's going on. They're nervous, and they're the ones that are standing around because there's just not enough people around right now. There's not enough volume. And as we get into September, this is classic, end of the year window dressing season, where portfolio managers have to they reposition their books to either take in some gains and lock them in, or get some losers off the books, or whatever it may be, and just reposition it. So when they come up for review, then their book is positioned the way they want to be able to talk about it for their bonuses. I mean, that happens every year. This is how institutions work. They get paid at the end of the year, and this last quarter is when things are priced out. So that produces a fair amount of uncertainty and repositioning in the markets, typically in September, October. And that's just the reality of the financial market. So
yeah, and we got quarter end coming up, and then there's always the dreaded October, which is generally when big crashes tend to happen historically. I have no idea why. There's also an argument to be made that altcoin season already started a while ago with the meme coin frenzy. And will any new altcoin season be any different from what we've already seen? Again, this is not necessarily going to be what we're going to be talking about here, because it has nothing to do with macro except risk sentiment and liquidity, obviously.
Can I make one point, Noel, which is a large part of altcoin season has to do with when your quants, when they look at markets, measure two things. I mean, people talk growth and value, but really it's momentum versus mean reversion. altcoins are the ultimate momentum play. People buy them because they're hoping that it will continue to move. And when they stop moving, they tend to go in the other direction, right? So the question is it a pause or is it a stop? And that, if you're asking, is there going to be an altcoin season? An altcoin season is really just an excessive amount of momentum playing in the market, right? That is the key, is understanding how, because these markets, Mike, one of the points Mike makes all the time, which is 100% right, is that, and this is true about crypto is a trader's market. There are investors in Bitcoin. Now, there are some investors in ETH and other places, but there are traders love these assets because of their volatility. Now, what does that volatility mean? Is it becomes self-reflexive. When momentum moves, they move. When it stops, what happens next? And then it's instructive to look at what you see here. And I think that we'll get a pretty good idea in the next 3 to 4 weeks as to whether or not there's any momentum that's going to be reintroduced into this market, one way or the other, because that is what matters. Because these things do tend to feed upon themselves on the macro side, because momentum is quite literally how almost the vast majority of crypto traders play it.
Yeah, especially in such a narrative-driven market. Now, we've only got a few minutes left, and so I want to go from the medium-term view to the short-term view again, and let's end with what each of you think will be the big takeaway from Jackson Hole on Friday. And notice that, again, this is on a Friday, so there's only one day of trading before we all take off for a nice, well-deserved weekend. But Mike, let's start with you. What do you think the main market takeaway from Jackson Hole will be?
Meh. I think it'll be a big fat nothing, and they're not going to do what they did last year and hint at cutting rates, because things were signaling that way. I don't think he's going to solidify the view of cutting rates, partly because we still have a lot more data to see before we get to the September meeting.
Dave?
I mean, honestly, I don't expect a whole lot. I think that, I just think it's more of the same. I mean, who knows? People will parse his words. And just like, when Besant said an offhand comment last week that took Bitcoin down, who knows? There could be offhand comments that matter. But my dead middle of the range is no, more of the same.
James?
Yeah, I think that he's going to point to things going the right direction, because that's good for the narrative of his legacy. And in saying that, it's going to open the door to that first September rate cut, but it's not going to be like, he's not going to solidify it. Like Mike says, he's not going to come out and say, we're definitely cutting, because then the market will rip, and the rates will, the probabilities will go to a 50 basis point cut. And that's not what he wants. But so he's going to temper it. He's going to remain, he's going to continue to lean on that line that they've been leaning on, which is, we are data dependent. And it's going to leave the door open to him to change his mind when we get another CPI number, the PCE number, another PPI number, unemployment numbers, all before the next Fed meeting. And so he's going to leave it open for him to pull back and say, the data's not there. But as it stands now, all things being equal, likely a cut is what will be gleamed from his comments. But again, the most important thing is the stuff he's not going to say. So that's really what you've got to pay attention to, in my opinion. So
To hear what he doesn't say.
yeah, exactly.
Of course. I have one quick follow-up for James, and zooming out a bit. Besant said last week that he thought the Bank of Japan should be raising rates now. Here we have the US Treasury Secretary getting involved in foreign central banks' economic monetary policy. What's your take on that? Is Besant just trying to talk down the dollar, or is he just posing for the TV?
Yeah, I mean, it's a little bit of both, probably, but like Japan's in just a totally different situation here. Maybe they're 50 years ahead of us, but everybody's turning Japanese, just like Mike said. And I think, Besant is trying to help rein in that situation there too. You don't want hyperinflation anywhere, and that would be bad for the entire market. So I think it's just, again, it's just posturing.
Yeah, let's hope so, because things are changing, but we can only take so much change at a time, right? That's all we have time for today. Unfortunately, I could, as always, talk to you guys all day, but I know we have things we have to get back to. So seriously, Mike, Dave, James, thank you so much. Thank you all out there for joining us today. And don't forget, tune in again next week.
Hey folks, a quick disclaimer. This segment is brought to you by a partner of this channel. Now, imagine front-running Wall Street on the world's fourth largest crypto, a deflationary powerhouse that yields staking rewards and fuels one of the most active blockchains on the planet. BNB has outpaced Bitcoin with 25x returns over 5 years, yet it's been off limits to most US investors until now. Enter CEA Industries, ticker BNC on NASDAQ, the first publicly traded company to adopt BNB as its core treasury asset, echoing MicroStrategy's Bitcoin playbook. Backed by institutions like 10x Capital and YZI Labs, they've already raised $500 million, positioning for massive inflows from ETFs, exchanges, and sovereign funds. Sophisticated investors, this is your backdoor to BNB exposure via a single ticker. Start your due diligence on NASDAQ BNC today before institutions flood in and the edge vanishes.